Hey guys, let me know if you guys can hear me, and we will go ahead and get started on our discussion here. Awesome. All right, so let's go ahead and get started. So, this is going to be kind of an open discussion. I have some points I want to talk about, but the main thing that I want to just kind of teach you guys tonight and talk about a little bit tonight is just risk management. So, obviously, just trading options as a whole is obviously risky already off the bat. So, I mean, some investments are risky. So, what we have to do is we have to think about how we are going to stay profitable, not only just today, but tomorrow, next week, next month, next year. So, it all comes down to, in my opinion, risk management. And I think there's a couple really easy and simple things that we can take a look at, um, and that can just kind of help us progress and have a better shot at making money and sustaining the money. So we're going to go ahead and move on here. So the first thing we're going to talk about is account risk management. This is pretty broad, but a couple things we're going to talk about. So the first thing you have to talk about and you have to decide when you get into this is what is the proper options. Now, this is options account size. So for me, I, of course, always err on the conservative side. So everything I'm giving you is very, very conservative, and it's conservative for a reason because my goal is to help all of you over time build an account to where you don't have to trade options and you can just passively invest and let your money work for you. And then trading options can be just for fun on the side to help build that even more. But we can only do that if we use proper risk management. Money does come and go. However, unless you have a steady stream of income, if that money goes, you may never get it back. You may never have another shot at trading options in order to build your account. So what I recommend for a proper options account size is 10% of your total portfolio. So that means 10% of your total money you have invested. So let's just use I'm going to just use easy numbers throughout this whole thing here so that way we can just make it very simple and understandable. So let's just take somebody that has a $100,000 account. Total investments, this is not a safety net, mind you. So if you have, I hope, a safety net on the side, your 6 months, a year, whatever you want to do for your safety net. This is outside of that. So if you had $100,000 invested in, say, just SPY, you could use 10% of that, which would be $10,000 to start your account. Same thing here. If you only have $10,000 invested, then you're going to start with a small size account like $1,000. Now, there are a lot of things that can vary this. So, if you are young, so I'm talking like, your 20s to 30s, and you have plenty of working years ahead of you, and you already have a strong career where you have consistent, stable income, this can vary. So, let's just use another example here. Let's say, you have a good safety net, 3 to 6 months, a year, whatever you want. You don't have very much debt, like outside of like a car maybe and like your house or something like that. And let's say you have a very strong, like, I don't know, $10,000 income a month or something like that. And your expenses are only like half of that, $4,000 to $5,000, and then the rest of it is 5K of profit every month or of savings every month. Then you might be able to go a little more aggressive. You could do, 25%, maybe even 50%. But with the same aspect of that, though, the higher you go with your options account size, the higher your risk. So you have to use proper risk management in that. It's okay if you want to use when you're 20, 30, maybe even 40 if you have a strong income and you've have a lot of money saved up or whatever, and you feel confident that you're going to have a stable income. It's okay to size up, and you can do a little bit more. So maybe you only have $50,000 total invested, but you want to start with that 25,000. That's something you can do, because well, if I lose all of that, which I hope you would know where to stop before you lost all 25,000, okay, well, I have 5 months of working and I'll build that right back. So something to keep in mind there. That's kind of how I recommend sizing your options account. Now, the next thing here is how to size a proper trade. So we're going to use the same example here. If your options account is, let's say, an $1,000 account, so small account here, I recommend using 10% of your account per trade. So that would mean about $100 a trade. Now, I know that doesn't sound like much. You're like, well, if I only win 10% of $100, that's only $10. Yes, but remember, this is a marathon. We're not trying to go out tomorrow, open an options account to start trading, and try to make $100,000. It's not going to happen. Yes, it's all over Wall Street Bets. Oh, I put $10,000 in the FRC, and look at me, I just made $200,000 overnight because it did X, Y, and Z. Or I bought Top on Friday and it went up 3,000% in one day. Yes, it happens, but that is the rarity or the exception. And we have to set ourselves up for success as the majority, not the exception. So again, about 10%. Now, again, this can vary because there's different ways to approach accounts based on the size. So if you were a larger account, say over the 25K pattern day trader, PDT, so you can use margin, you can get in and out of positions. So let's say you have 30,000 in your account. 10% of that is what would be recommended, but you can go a little bigger than that. You could do 5,000 per trade, 6,000 per trade, but you have to remember, with stop losses, as soon as you get under that pattern day trader, then you put yourself in a position where you either have to go cash account, or add funds to your account. So it's all a balancing act, and the whole purpose of the balancing act is longevity, which means you are trying to stay in this game. This is a game. It's a hard game. Option trading is very, very difficult, but there's ways to stay ahead. And you have to size appropriately for drawdown. Nobody is perfect. Even me, there's been a couple weeks here and there where I can, pull out 100% week, 100% day, things like that. But the majority of people are only doing 50 to 75% win rate, but they're profitable in it. So you have to price in the fact that you're going to have drawdown. So if you only have, $26,000 in your margin account and you want to trade on that, you do a $5,000 trade and you take a 10% loss 2 times, you're now under the margin requirement and you can no longer day trade. Things you have to keep in mind when you're building your account. So next thing we're going to talk about is stop losses. This, in my opinion, is probably the number one way to stay not only profitable, but win in option trading and win in investing. And again, guys, if you have any questions throughout this, just put them in the chat and I'll get to them. If you're on the Discord, you can go ahead and put them in the Discord. I'm monitoring the channels and I'll reply to whatever you guys have questions about. Like I said, this is an open discussion. I have some points, things I'm going to talk about, hopefully to help you guys. But outside of that, if you have questions, just let me know. So anyway, stop losses. When to use a stop loss. In my opinion, you should not enter a trade without a stop loss set. So the question is, how do I set those stop losses? Well, there's 2 different types of stop losses. And I'm not talking about order type. I'm talking about how you use your stop loss. There's some people who are very mechanical. So they don't need to set an automatic hard stop loss where the broker automatically will calculate, you lost 10%, I'm selling your order now. There's people that can do that. And if you're one of those traders where you can be in a trade, it goes 10% against you, and you're like, you know what? Darn it. I messed up. Not a good entry. It's all right. I'm taking my negative 10% loss or whatever you get. And I'm going to look for my next entry and I'll be ready to go. If you can do that, that's fine, honestly. You can do that. However, for 99% of people, even myself, I highly recommend using what's called an OCO order, which is one cancels other order. So basically how these work, if you use desktop, and I'm going to reference Thinkorswim because that's what I use. On Thinkorswim, on the desktop, you can set what's called a template. So what I have mine set at basically is I have my position size for my order when I want to buy in, like how much dollar value I want to buy per trade. And then I also automatically have it set as a 10% stop loss. So what that does for me, one, is it takes the emotions out of it. And that's something we're going to talk about here in a couple minutes, is emotions in trading. So for me, it takes out the emotions, which is big because you can't be emotional in trading. And what happens a lot of times, and this used to happen to me, and if you guys have been with me for a long time, you know I never used to use hard stop losses because I always felt like I was smarter than the trade. I said, oh, you know what? I know this is coming back. I know I just got a bad bounce. I know this. I know that. But end up what happening is, because of options and the nature of options, is you end up getting hit with massive theta decay or IV crush or whatever else happens. And that position, while you could be right, that maybe you did get a bad bounce, maybe you got a rogue like on Friday sell off of $2 out of nowhere, and it's going to come back and it's going to go higher. But a lot of the times, by the time it does come back for you and it does go higher, it's not worth it. We're better just selling at the stop loss and repositioning. So for me, I prefer a 10% stop loss. For me, I feel like I have pretty solid entries most of the time, and I have pretty solid exits. So for me, a 10% stop loss is about the variant of a rogue bounce that is going to come back my way. But honestly, from what I've noticed, that if I'm wrong 10%, then I just had a bad entry and I misread the market. And that's okay to be wrong sometimes. You know, we're not going to be right all the time. I've slowly worked my stop loss up over the last probably 7 or 8 months now, from I think I started at like negative 20-30% maybe, to recently I went to negative 10%. And I think that's about as tight as I'll go, just because premiums do vary and sometimes the spreads get wonky, and I'd hate to get stopped out just because of a weird spread or something like that. But a reason to use the stop loss here, so let's take a $1,000 trade. If you use a 20% stop loss and you get stopped out at negative 20%, so you take your max $200 loss. So now what do you have to do to win that back? You have to either do 1, 20% win, 2, 10% wins, 3, 6.7% wins, or 4, 5% wins. That's manageable. You can do that. That's easy. That's a 75% win rate to get that back. But what happens if that same negative $1,000 trade becomes a full negative 100%, which usually what happens with options when it goes away from you? Well, now you need 100% win, 2 50% wins, 3 33.4% wins, or you need 4 25% wins. Now this is where that's a lot more difficult. Talking about 25 to 100% wins and numerous ones of those, that's more difficult. That is why I use the stop loss. Now I have another slide coming up that's going to show that even more important. The next thing is about taking profits. When do we take profits? This is something that a lot of people struggle with, and this is where you have to understand that in trading, we are not taking the full move. So if the full move is, let's say, $1 range on SPY. So your full option move was $1. And let's say that full move for the algo or the computer that made that happen was a 50% gainer. Your goal is not to get all 50% of that. Your goal is to get the breadcrumb. So your goal should be to get like 10, maybe 20% of that. So you have to keep that in mind when you enter a trade. another thing to remind you of, and I say this a lot in my Discord of, they're like, how did you time that exit perfect? What I look for is a pause in price action. So what I mean is, let's say SPY's at, I'm just going to use simple numbers here. Let's say SPY's at 400 and we think it's going to go up, so we take a call. So SPY pushes to 401. Again, we're just using simple numbers. This is not a realistic trade, just using simple numbers so you understand. So it goes from 400 to 401. Wow, that's a nice, let's say 20% win. Perfect, right? So do we hold or do we take profits? Well, what we're going to look for is, does price action continue to move? So if we sit at 401 for, 10 seconds, maybe 20 seconds, and we're not moving off 401, and you're watching the premium, I'm always watching my premium with a limit sell, or sometimes a market, depending on what the market is. You always are watching premiums. As soon as that premium stops moving in your direction and it pauses, that is your exit. That tells you the move is complete. Now, there are times where it will move back towards against you, and then it will move even farther. And yes, you're going to miss that move sometimes taking profits. But I would say, having watched SPY and just the way it moves, 90% of the time, if you do not sell when that pause happens, it's going to go back and either hit your stop loss, or when it remakes that move, you are not going to see more profits. You can ask anybody that trades SPY regularly, especially options and low DTE options like 0 to 3. I would say 90% of the time when it moves $1 in your direction and say you get 20%, if it moves 50 cents against you and then moves 75 cents or $1.25 in your direction now, you're still going to get about the same profits. But your chances of hitting your less profits grows if you don't take that profit. So something I've been doing a lot lately, though, is just setting a profitable stop loss. So you can set, depending on your broker, Thinkorswim again is my reference here, you can set a profitable stop loss. So what this means is, let's say we're at 7% profits on our option. You can go into your broker and you can set a limit sell with either, usually you have to calculate out like the actual premium price. So let's say like you bought it for exactly $1, you're up, so it's 1.07. You can go in and set a 5% stop sell at like 1.05, which would be 5% profits on $1. So basically what that means is, as soon as it backtracks, the price goes against you and it hits 5%, boom, your order sells and you have guaranteed profits. Never ever let a trade go red. Always. You know what? And sometimes you're going to have a move that you're like, dang it, this is the best move. This is going to be big. I'm going to get a huge win here. And then it moves and it just doesn't pay. That happens with options sometimes. Take that 3%. Take that 5%. Take that 1%. Because you know what? A 5% win on, let's say, $1,000, yeah, that's only what, $50 or whatever. But if that goes back and stops you out now at your negative 10% stop loss, you not only lost $100, you lost $150. Why? Because you had $50 of potential profits that you did not take. And instead, you took a stop loss at negative 10%. That's a $150 swing instead of just $100 or a $50 profit. That is the psyche of trading. Knowing how much a profit versus a loss affects your account. So next thing I'm talking about here is sizing up. So what I refer to when I'm saying sizing up is when you start trading, you need to start on baby steps. What do I mean by that? Let's say let's use our 1,000. Let's use a bigger account because it's a little harder to size up with a smaller account, but that's something you do over time. So let's say you have your day trading account. You have your 30K. So let's say you decide, I'm going to start with $2,000 a trade. You go through a month of trading. You're like, you know what? I'm doing pretty good. I'm making some profits. My account's up to like 35,000 now. Whatever. I want to move up. That's what sizing up is. Now you're ready to risk up because you feel comfortable and you think you're ready to do it. And you have the emotion, you have the strategy, the mechanics of trading and moving up. I would recommend sizing up in 10% increments. So let's say you use $1,000 per trade. That means you would size up to about $1,100. And then if you want to size up from there, you go up to about 1,200. And then you can just kind of slowly build up. The whole point is to not size up so much that the emotions get you. So what ends up happening is that, let's say you're doing $2,000 per trade. So you're like, you know what, my 10% stop loss, that's only $200. That's not really a big deal to me. So then you're like, you know what, like I just made $3,000 last week trading on a $2,000 position size all week long. I want to make $6,000 this week. So you go from a $2,000 position size to $4,000 because I want to double your profits. But what happens is now that negative $200 that doesn't really seem like a big deal in a big account becomes a $400 loss, and you're like, ooh, that's big loss right there. That kind of messes with you now. So you have to size up slowly so it doesn't affect the way you see the numbers. Because once you start seeing those dollar signs, especially when they're going against you, it changes your emotions and it makes you make mistakes and do things you shouldn't do. It also affects you in the profit size. If you go from, okay, I got 10% win on my $2,000 trade, that was a nice $200, but now you size up to $4,000 and you're like, well, I'm at $400, that's really good, but let me push this to 20%. Let me try to get that 20% win, because that's $800 and that's like 4 trades from before. So then you start pushing plays and you start pushing yourself, and then you end up start taking losses, and then you start getting emotional and revenge trading, and it becomes a very, very, very slippery slope. Another thing I recommend about sizing up specifically is to never size up during the week. Whatever you start trading with on Monday is what you should finish trading with on Friday, unless you are sizing down, of course. Why? Because it messes with everything. So let's say Monday and Tuesday you traded with $2,000. So let's say you hit a good profit. You hit $1,000 of profit total on Monday and Tuesday. So Wednesday, you're like, I'm going to size up to the 4,000 now. I'm going to go big. So Wednesday comes, you take 2 losses to start the day on Wednesday, and you have raced at 10% loss. You have erased the whole week's profits besides $200. And then now you're in your head, you're like, dang, I just lost in 2 trades. I just lost my whole week's profit already. It's better just to stick it out for the week, do the same position size, stay consistent, and don't mess with your emotions and your mechanics. So now the next thing we're going to talk about, and this is a very important one, is sizing down. When do you size down? So this is where you have to humble yourself. If you're in a position size like I was just talking about, where you are so focused on the numbers and you are so focused on the fact that, ooh, that was $400 I just lost in that trade. That's a lot of money. I can't tell my wife or my husband or whoever, your friend, that I just lost $400 in that trade and I shouldn't have done that. You are sized too big and you need to size down immediately. Another reason to size down is, let's say, I have had this happen myself. And actually, I sized down in 2022 and I still have not gone back to my full position size yet. Strictly because of the market, and I just don't think it's worth the risk to reward to be back to my full size yet. And I'm just comfortable in my size I'm at right now. But when you go through a bad stretch of trading, let's say you have a week or two of being unprofitable, there's nothing wrong with sizing down. Like, let's say you're trading that $2,000. Size down to $1,000 and get back into your comfort zone. Get back into confidence. That is the most important thing in trading. You have to be confident. You have to be at a point where you enter these trades and you exit these trades and you are confident. If you're too strong of a position size where you're not confident, or you're too nervous about losing the money, you're never going to win. So that's a good time to size down. So when it comes to sizing down, though, I actually recommend sizing down by about 25% initially. You could size down by 50% depending on how big your already position size is. So let's just say you have a $1,000 position, general statement. You would go down to about $750, if not $500. So just cut it really like right in half, 25 to 50% off. The last thing to talk about here is paper trading. Now, I know this is like such a taboo thing, and everybody's like, oh, you shouldn't paper trade. It's not the same emotions. It's not this. It's not the same. Blah, blah, blah. Honestly, in my opinion, if you cannot paper trade with the proper emotions like it's a real account, you're probably not going to succeed in a real account. You should set up a paper trading account for the realistic size. So on Thinkorswim, you can message the customer support and say, hey, I want my account size to be, let's say, $10,000. And they'll adjust it for you so you have a $10,000 account. Trade that account like it's real. Now, yes, I know on especially Thinkorswim, I haven't really used paper trading on any other account before, but the fills are very unrealistic. Many of the things, like you can't get in or out of positions just because of the spreads, and like there's definitely, even with real-time data, there's still a lag. But what you can do is you can watch the premium. So let's say you want to get into a trade. Get into the trade, watch the premium. So let's say you enter at $1 on, it's $1 premium. Okay, watch it. What happens? Price goes up. Okay, I think my move's over. I want to get out now. See where your premium's at. Hand calculate it. Start calculating it that way, watching it. I really think 99.99% of people should start with a paper account. Get the mechanics of how an option moves, how to get in and out of a trade. Because honestly, that's something that I had this happen once when I was on an airplane. I was trading and I had never used the web version to get in and out of a trade before. I only used mobile and the desktop. At that time, desktop very briefly. I mostly was mobile trading back then just because it was what I had done for so long when I was working. But and I had to make a trade on the web page, and honestly, I had no idea how to do it. And I didn't realize until I was in the trade, and I was like, dang, I don't even know how to get out of this trade. Use the paper account to figure out how to do that. Figure out how to get in a trade, get out of a trade, figure out how to set up OCO orders so that when you enter the trade, it doesn't immediately sell the trade. Because I've had that happen before when it's not set up properly. Use that for trial and error. Figure out, what size you want, what size you don't want. And another thing is, if you go through a really bad stretch of trading, let's say you have like a month period of where you're not profitable, and you're like, you know what, this is maybe too much for me. If you don't depend on that income, which most of us probably don't depend on trading income, this is like a second venture to build more capital, go paper trade. Go trade and get back in your comfort zone. Get back your confidence, and then come back and attack the market ready to go. Okay, next thing we're going to talk about here is limiting big losses. I think this graph here it just really shows, one, the importance of stop losses, and two, just the importance of risk management. So like, look at this here. So let's say we have a 10% stop loss. It takes an 11% trade to get back to even, to recover your losses. You go down to a 20% stop loss, that's 25%. Now a 90% stop loss, 900% to recover this loss. Now a lot of this applies to cash only accounts where you aren't like doing the same position size over and over and over. Because obviously if you make losses, you lose that income you can trade on anymore. But this graph here is absolutely, if you ever need a reason of why you should use a stop loss, you should look at this graph. Okay, next thing to talk about is emotions. We have to be robots in a way. Why? Because this is something I struggled with in 2022 just because of the bear market and how much technicals had changed and trading is changing, was that I lost my confidence. I would see a position, I would see a play, and I was like, dang, like that looks right, but I just don't trust it. I don't want to get into it because I was too nervous about being stopped out than I was of being confident in my trade. When we're making these trades, we should be confident without being reckless, which means you have to take your emotions out of it. You have to be like, okay, I know this is a good setup. I'm taking that trade. But we can't be so robotic. You're like, I don't care if I lose or not. I'm taking the trade anyways. It's a very, very fine line. Another thing, and I said this a lot on Thursday and Friday, if you were in the server, and I mean, Thursday was really rough, but Friday we ended up being profitable, but it was really bad too. Just with the technicals and everything. From an emotional standpoint for me, I would rather enter a trade and get stopped out, but have entered it on a good basis, which means I would rather be wrong or get stopped out, but have followed every single one of my rules for my strategy. So let's say, I'm looking for X, Y, and Z before I enter a trade. If X, Y, and Z is happening, I would rather enter that trade and just be wrong and get stopped out than to say, well, this looks like it's going to be a good trade and I want to be emotional because it's just running straight up all day and there's no reason to be bearish here, and let's FOMO into it and take a call for no reason. And then you get stopped out. You can't break your strategy and break your rules just because the day changes a little bit, just because things don't play out correctly on 1 or 2 days a year. Another big thing is, and this is for all you guys that are kind of coming from Wall Street bets and, all you've ever seen is big YOLOs and big losses and big gains. You have to lose the YOLO and FOMO mindset. Until you can break that mindset, you will never make it long term in options trading. And another thing is, for me, the way I run my trading and my server is this is not a get rich quick scheme. This is not, let's go make $100,000 this month and whatever. This is a long-term strategy to grow an account, to grow your investments, to grow everything that you want. Next thing here is risk to reward. And this goes a lot kind of with the emotion side of things. Every single trade we take should be an A+ setup, which means if you are entering a trade, the risk to reward should be perfect. You should not be going into a risky trade for no reason. You should not be going in and be like, well, I know this is super risky and I know I'm probably wrong, but man, if I'm right, it's going to be great. That's not the trade to take. Every strategy, whether you are following me and you're watching my entries and then you're making your own entries, or you're following somebody else, or you're doing your own trades based on whatever, every strategy should have a clear-cut set of rules for entering a trade. If it does not, you don't have a sound strategy. If you can't put to paper that I look at A, B, C, D, and E to enter a trade, and when all those align, I take the trade, you do not have a proper risk to reward strategy. You are trading on mostly, I would say, probably FOMO and maybe a partial strategy. Your strategy should be very clear, cut, and dry. So same thing, much like Thursday and Friday, especially Thursday, that was not for me a good day of trading for my strategy and my type of trading. And I knew that probably midday when I started struggling really bad. I knew that was an extreme momentum day, and I know those are the days I struggle with. So what you need to do on those days is walk away. Now I know it's a little harder for me to just walk away, but for you guys, if you recognize a day that's not your day, walk away. There's 252 trading days in a year. Wait for your day and capitalize on that and make your money. Next thing here is how to build a low budget portfolio. So there's a couple different ways to do this. You can either do, and this goes with my 10% challenge, and it's explained in the Discord. I do plan to do a YouTube on that, maybe either next weekend or the weekend after that, to kind of talk about that more. But there's two different strategies. So if you're a low budget portfolio, you can either, or I guess I would say there's three different ways to do it. You can either, you're basically full porting, but you understand that it's a stop loss and you're slowly trying to do the 10% challenge, which basically you're looking for one solid, good setup a day to take a trade and take a small profit, and then you move on to the next day and you do the same thing, and you're just being consistent with that, and you're very much so limiting your losses so that way you can recover it easily the next day. That goes back to that chart that I showed you above. The other way to do that is taking small, numerous trades. So the same thing. Let's say you have your $1,000 account here. You take your 10 $100 trades a day, and you're just looking to be consistent. What you're doing with that is you're looking to build a strategy while you build that account. So yes, you're going to slowly build that $1,000 account with options wins, $10 here, $5 there, $6 there, whatever. But you're also doing that so you can have a strong base and a strong strategy for when you get to a large account, so that way you can be mechanical and you can win with that large account. Now, the other option you have, there's really three options. Like I said, this is the last option, is to just paper trade while you build that portfolio. Is it impossible to start with an $1,000 account and build it to a $50,000 account? No, absolutely not. People do it all the time. It's very, very hard, but it's not impossible. However, that is, again, the exception, not the rule. What I recommend for most people, if you're not starting with probably at least a $3,000 account, so you can make like at least a $200 to $300 per trade and be able to make a handful of trades a day, you should be paper trading to build a strategy, to build mechanics, to build understanding of options, and to build success while you are working and bringing in additional money to fund this account, so that you can start with an account size that you're going to see substantial profits. The biggest thing I see people with small accounts do is that they basically just say, I don't care. Why? Because they're like, well, I'm only making $1 I'm only making $10 of profits on my $100 trade. It's just not worth taking a 10% on that. I'm just trying to get my big wins, and I'm trying to get my 100% win. So then I have $200 to trade the next day. That's great and all, but what ends up happening with that is you end up just getting stopped out, and you end up losing that whole $100 because you end up taking such risky trades. And then what ends up happening is you're, oh, well, I lost my $500 port, so I'm just going to refund that next week and then try again. And then they end up doing that like 4, 5, 6, 7 times. And that's even 5 times of putting $500 into your account and losing all of it, that's $2,500. If you just waited until you got to $2,500 and then traded $250 of position size and took your 10% profits, you would be doing so much better and doing yourself so much more of a service. Like I said, I know a lot of people look down upon paper trading, but honestly, there is a place for it, and it will help you build your mechanics. My last little thing here is cash only accounts. So if you are under $25,000, really if you're under like $27,000 because you really can't get in and out of trades without getting a stop loss, you should be using a cash only account. Why? Because overnight on options, your money settles every single day. So let's say you have a $10,000 cash only account. You can trade that full $10,000 on Monday. Come Tuesday morning, assuming you closed all trades before end of day, you have your fresh $10,000 plus profits or losses the next day. So if you're doing 10 $1,000 trades on a $10,000 cash account on Monday, you get to do 10 trades. Come Tuesday, assuming you made profits and you didn't take a big loss, you get to do 10 more trades. Same thing on Wednesday and Thursday. That's how you build a small account. You are doing small, consistent, grinding plays. There's just no other way to do it, honestly. You just have to do it. The next question, and this will be almost one of the last slides. We've got two more after this. Should you set a daily dollar or percent goal? Or should you even set a goal? For me, I have a daily dollar set and I have a weekly goal set. For me, when I came into trading full time after leaving working while trading, I told myself my goal, and again, I know I don't hit it every week, and some weeks I hit more, and it's just how it is, but was basically to be able to make what I was making working full time. And for any of you that are transitioning into day trading full time, that's a good goal, I think. But that's a dollar goal. That's not a percent goal. So I think a lot of people are like, oh, my port went up 2% today. That might be cool, and that's fine for them. If they have $1,000 account, I mean, that's not very, $20. So you just have to be careful with a dollar versus percent. And then what happens is, so let's say you have a percent goal. Let's say your goal is to build your port by let's say 1% or 10% every day. So let's say you have $1,000 port. Okay, I hit my 10% profit today. Sweet. So then next week, now your account maybe is up to $3,000. You're like, well, I still want to hit my 10%, but you're only using the same, now you're making $300 versus $100 a day. And then the next week you have $5,000 maybe. Or when you build up to like a $25,000 account, you're like, man, I really want to see that 10% profits in my account every day. That's harder to obtain, and it's much more unrealistic. However, you can set a reasonable dollar amount. It really should be about 10% of your trading position size. So if you say you have a $2,000 per trade size, you should be looking for about $200 a day. Just set a realistic goal. Don't set such a crazy goal that you go chasing it and you end up losing it. And another thing is, when you get to the end of the week, say you have a weekly goal of $2,000. If you're at on Friday $1,500, don't be like, man, I have to hit $500 today so I can get my $2,000 goal. Because what ends up happening is you end up breaking your rules, you end up taking risky trades, you end up forgetting to take profits because you're trying to push that 2% to a 10% win, or that 10% to a 20% win, and you end up making mistakes, and then you end up going from a $1,500 week, which is a really nice win, to a $1,000 week, or a $500 week, depending on how bad it got. Set realistic goals without pushing yourself too hard. As you become more successful, you can grow those goals to dollars in different amounts. The last thing here is when to take a mental break. It's a great question. So this varies on everybody. If you're in trading every day, this is something you do every day, whether you're a full-time trader or you're trading while you're working, which I know a lot of you guys do that, or you're trading just for an hour, like in the mornings before work or whatever. Set a time where you're going to take a break. So like a really good trader that I highly respect, if he has a very, very bad day, like takes a big loss, he takes a couple days off before, and then he comes back. Because what ends up happening is we allow ourselves to get so caught up on the numbers that we end up revenge trading and over trading. So I would honestly recommend, if you have 2 red days in a row, take the 3rd day off, or take the 3rd day to paper trade. Take that day to get back your confidence. If you get to a point where you're so frustrated and all you're telling yourself is, I just can never win. Every trade I take goes against me, or, well, the reason that it went against us is because I entered that trade with you, or you say, man, literally every stop loss is just getting hit. I haven't made money in 3 days, in a week, blah, blah, blah. Once you start getting down on yourself, it's time to take a break. Especially if you don't depend on this income for like living, take a break. Don't stress about this. There is 250 roughly trading days a year. Don't stress about it. Take a time off. Take the time you need. So this is just the last slide here, and then I'll take any questions anybody has. But something to remember, there is 250 roughly trading days a year. You do not need to make a year's profit in one day. You know, this is a great, perfect example of how small profits add up over time. If you are trading a small account, let's say, and your goal is just simply $100 a day, that's all you want to make is $100 a day, you can make $25,000 in a year trading. That's a hefty amount. I mean, for some people, depending on what part of the country you live in, how old you are and stuff, I mean, that's a year's salary for some people. Just $100 a day. $250 a day. That's almost $63,000 a year. That's pretty much that's over the median salary for most people. That's a hefty amount for just $250 a day. 10% on $2,500 trade. That's it. And you can make $63,000 a year. Again, though, this is trading over time. This is not full porting $2,500 trying to make $2,500 in one day. This is small, consistent gains over time. $500 a day, $125K a year. That's 6 figures just for $500 a day. You know, that's a couple 10% wins on a $2,500 account, on a $2,000 account. Just small, consistent. You know, and you can see how it goes up from there. $1,000 a day. Now, of course, this is for our big port people, but $1,000 a day, that's $250K a year. That's a lot of money. You know, if you can make $1,000 a day trading, I mean, that's a lifetime of money right there for most people. That's money that most people will never see in a year. Even $250 a day. I'm telling you, there's a lot of people, and I've been around the world. I've lived in many different states. I've had a couple different jobs in educations and things like that. Talked to a lot of people. $63,000 is a lot of money to a lot of people. That can do you a lot of good. If you can be disciplined and you can make small, consistent, marathon-based gains every single day, or not even every day, a couple days a week, a couple days a month, that money adds up over time. But I'm telling you, like I said, the whole point of this is risk management. If you do not manage your risk, you will never, ever be able to hit these numbers. You will never see $63,000 a year if you don't manage your risk. If you let that risk get away from you, you will never see it. You have to start small and build up. Do not compare yourself to others. Just compare yourself to you and do you. All right, if nobody has any questions, I'm going to go ahead and end here. I hope you guys enjoyed this. This was a fun one for me to make. I actually really enjoy doing these videos because they're also just nice for me, nice reminders about just the basics, things that, you know, you learn early on in trading, or some people never learn them. But for me, they're really nice reminders. So I did enjoy doing this video. I hope you guys enjoyed it. If you have any questions about risk management, either drop me a comment in the Discord, on YouTube, or send me a message. So hope you guys have a good night, and I will see you.